Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the provisions of the Department of Education's new Saving on a Valuable Education student loan repayment plan. Spidell's Federal Tax Letter is a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the topics that will impact your clients. You can download a sample issue and get more information on this monthly publication at spidell.com under Publications. Student loan repayments and programs typically have minor significance for tax professionals because so many clients who have student loans make too much to actually deduct the interest. But there are a couple of important changes to the student loan repayment rules that can save clients thousands of dollars. Student loan repayments and interest charges have been on pause since the start of the COVID-19 pandemic over 3 years ago. Interest on loans will resume on September 1st, 2023, and payments will restart in October 2023. When repayments begin, a new Department of Education income-driven repayment plan will be in effect, called the Saving on a Valuable Education Plan, also known as the SAVE plan. The new SAVE plan will replace the existing revised pay-as-you-earn repayment plan. The SAVE plan increases the income exemption from 150% to 225% of the poverty line. This change can significantly decrease a borrower's monthly payment amount compared to other income-driven repayment plans. A borrower's monthly payment amount is based on their discretionary income, defined as the difference between adjusted gross income and 225% of the Department of Health and Human Services poverty guideline amount for the taxpayer's family size. For undergraduate loans, the SAVE plan reduces the required payments from 10% to 5% of the borrower's discretionary income. The new SAVE plan removes the spouse's income from this calculation for married filing separate taxpayers. This change can help taxpayers further lower their income for purposes of their loan by filing separately, but tax professionals will need to keep the following in mind. Taxpayers in community property states split community income between spouses, so filing as married filing separate may not help all taxpayers in those states. And some tax attributes are not allowed or are modified for married filing separate taxpayers. For example, the taxpayers may not be eligible for the Child Independent Care Credit and the Premium Tax Credit. Filing status will determine whether the spouses both itemize or both use the standard deduction. And the AGI phase-out for IRA contributions is capped at $10,000 if the taxpayer is a participant in an employer-sponsored plan. The loss of potentially valuable tax attributes like these needs to be taken into consideration when determining whether to file separate returns for a married couple. The U.S. Supreme Court struck down President Biden's broad loan forgiveness program, but existing loan forgiveness plans under the Department of Education's income-driven repayment programs have been expanded. The SAVE plan creates a new classification for those whose loans totaled $12,000 or less. These borrowers are eligible for loan forgiveness after making payments for 10 years. The SAVE plan also helps prevent loans from accumulating excessive interest where a student's minimum payment is not enough to cover accrued interest. Under the plan, when a borrower's required minimum payment doesn't cover the interest charged for that month, the remaining interest is not added to principal, it's forgiven. Get an update on all the news that happened during the year as part of Spidell's Federal Tax Update webinar on January 4th and 5th. You can see what will be covered in this 8-hour course and register at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.